studying your last two. I swim med when turned in. The staring down to mute. And can learn the pole that sunk he died.
Before a corporation can pay a salary to its owner-manager, the payroll system must first be set up correctly. Even if the owner is the only shareholder and controls every decision in the business, they must still be treated as an employee for payroll purposes. Simply transferring money from the corporation's bank account is not enough to create a valid salary payment. The first step is to register the owner as an employee. Just like any other employee, the corporation records basic payroll information, such as the owner's legal name, social insurance number, address, employment start date, salary amount, and how often they will be paid. Once this information is entered, the owner officially becomes part of the corporation's payroll system. Next comes the TD1 personal tax credits return. This form is completed by the employee and tells the employer how much income tax should be withheld from each salary payment. Using the correct TD1 information helps ensure that payroll deductions are calculated accurately throughout the year. After the employee information has been collected, the corporation must decide how payroll will be managed. Some very small businesses perform payroll manually using CR payroll tables. But this approach requires careful calculations and is more likely to result in mistakes. Most corporations today use payroll software that automatically calculates payroll deductions, prepares payroll reports, and helps keep the business compliant with CRA requirements. Some businesses even outsource payroll to professional payroll service providers who manage the entire process on their behalf. Whichever method is chosen, the objective is the same: to ensure that every salary payment is calculated correctly, the required deductions are withheld, and all payroll records are maintained properly. Once the owner has been registered as an employee, the TD1 form has been completed, and the payroll system is in place. The corporation is ready to begin paying shareholder salaries through payroll. The next step is understanding what happens each time payroll is processed. Once the payroll system has been set up, the corporation follows the same payroll process every time it pays the owner-manager. Each payroll cycle follows a structured sequence of steps to ensure the salary is calculated correctly, the required deductions are withheld, and all CRA reporting requirements are met. The process begins by choosing the payroll frequency. Depending on the corporation's policy, the owner may be paid weekly, bi-weekly, semi-monthly, or monthly. Once the pay period arrives, the corporation calculates the owner's gross salary, which is the total amount earned before any deductions are made. The next step is to calculate the required payroll deductions. These normally include federal and provincial income tax, along with Canada Pension Plan, or CPP, contributions. In most situations, owner-managers are exempt from employment insurance, or EI, premiums, so EI deductions generally do not apply. After these deductions have been calculated, the corporation pays the owner their net salary. This is the amount that remains after income tax and CPP contributions have been deducted from the gross salary. Most corporations make these payments through direct deposit or electronic funds transfer. The corporation must then remit the payroll deductions to the Canada Revenue Agency. These remittances include the income tax withheld from the employee's salary, the employee's CPP contribution, and the employer's matching CPP contribution. For most regular remitters, these amounts must be sent to the CRA by the 15th day of the following month. Missing this deadline can result in interest charges and financial penalties. Every payroll run must also be properly documented. The corporation should maintain payroll registers, accounting records, salary calculations, remittance confirmations, and supporting payroll documents. These records are essential for year-end reporting and provide evidence that payroll obligations have been fulfilled correctly. The important point to remember is that paying an owner-manager by salary involves much more than simply writing a check. Every payroll cycle requires calculating the gross salary, withholding the correct deductions, paying the employee, remitting payroll amounts to the CRA on time, and maintaining accurate payroll records. Following this process consistently helps the corporation remain compliant while ensuring the owner's employment income is reported accurately for tax purposes. At the end of every payroll year, the corporation has one final responsibility: reporting the salary that was paid to the owner-manager. This is done by preparing a T4 slip, one of the most important payroll documents in Canada. The T4 summarizes the employee's total salary, the income tax that was withheld, the CPP contributions made during the year, and any other required payroll information. A copy of the T4 is provided to the owner-manager, and another copy is filed with the Canada Revenue Agency. In most cases, both the T4 slip and the related T4 summary must be submitted by the last day of February following the calendar year. Preparing the T4 is not simply a year-end formality. Before it is filed, the corporation should reconcile its payroll records to ensure everything is accurate. The total salaries paid during the year should match the payroll records, the payroll remittances made to the CRA, and the amounts reported on the T4 slips. Any differences should be investigated and corrected before filing. Maintaining accurate payroll records throughout the year makes this reconciliation process much easier. Every payroll run, every deduction, and every remittance should be properly documented so that the corporation can demonstrate compliance if the CRA requests supporting information. There are also several common payroll mistakes that corporations should avoid. Failing to set up a payroll account before paying salary, missing payroll remittance deadlines, calculating CPP contributions incorrectly, filing T4 slips after the deadline, or paying salary without properly reporting it can all result in penalties, interest, and additional CRA scrutiny. During a payroll review or audit, the CRA may examine payroll accounts, salary records, CPP calculations, payroll remittances, T4 slips, and supporting documentation. Well-organized payroll records not only make the audit process smoother, but also demonstrate that the corporation has fulfilled its payroll obligations correctly. The key takeaway is that paying a shareholder's salary doesn't end when the money is deposited into the owner's bank account. Proper year-end reporting, accurate payroll reconciliation, timely CRA filings, and complete record-keeping are all essential parts of the payroll process. Following these procedures helps the corporation remain compliant while ensuring the owner's employment income is reported accurately and confidently.